The first one will be for withdrawals. This is if the owner takes money out of the business. This is what partners do when they want to pay themselves or take out additional money. It's their business, whatever they have contributed into the business and whatever the business makes, the owners can withdraw that out. As a reminder, when owners put money into the business, it will increase their capital account. And when owners withdraw from the business, that will decrease their capital account. The journal entry would be the partner's name. For example, if it was me, it would be Kroger, withdrawals, and then a credit to cash because cash is coming out of the business. Then at the end of the year, you need to close the withdrawals account to the capital account. Basically here, decreasing capital. Remember, capital is a credit account. You can always remember CC, C for capital, it's a credit account. When I do a debit, it means I'm taking it down. I'm bringing it lower, taking money out of that account. I'll get rid of the capital at the end of the year. So these cancel out. And it basically just gets withdrawn from capital. Next, we'll discuss net income and loss. This is a topic that we'll be covering for the next few slides. First, I just want to go over the journal entry, then we'll look at the amounts. A partner's capital account will be credited with net income, or it would be debited if there was a loss when closing the accounts out at the end of the period. I'm not sure if you remember from Accounting 1, but the account income summary, that's a summary of all the income. Basically, the step before this is closing revenue and expenses into this account and having income summary be a total of the net income, then closing this account to the capital accounts. This amount here in income summary would be the amount of net income for the year, and then you would split it up between the different partners. You would list partner 1, then the next partner underneath, and then the next one. We would do this all in one entry. I only have one partner's capital account here, but you would list them all, and you would divide this income between all of the different partners that you're listing here. This would be the entry if there was net income. If it was a loss, you would flip it. The entry would be reversed. Basically, the partner's capital accounts would be decreased if there was a loss. All of our examples we're going to do, there's only going to be net income. We're not going to do any losses. Next, we'll go over how we determine what each partner will be getting in income. I mentioned this in the last slide that if a partner wants to pay themselves, they'll do a withdrawal. That's because partners are not employees. They are owners of the business. Salary expenses are not going to be an expense that will offset the income here. Instead, it would be a withdrawal. There are different ways to decide how we're going to split up the income. A few of the methods, and there are more, would be one is using stated ratios. That's like saying, let's split it up 50-50 or 70-30, 70% to you, 30% to me. Or if we have 5 partners, let's just do it all equally. Having a specific percent would be the stated ratio. Another way would be based on capital balances. The partners with the higher capital amounts will get the most income out of it. We'll add up all of the capital balances and see how much each partner's capital is to figure out a percent. Another way is a combination. Salaries would still be considered a withdrawal, but we'll call it a salary to each of the partners. Then it could also be based on maybe a certain percentage of their capital as interest. A lot of companies do this to incentivize the owners for leaving money in the business. They'll give interest based on their capital. I might not withdraw money, I might leave some of it in the business so that it does earn interest. And then what's ever left over, we can split on a specific ratio. There are combinations of all of these together. These are just a few of the examples that we're going to cover. We're going to practice each one of these next. We have Superman, Batman, and Aquaman. They invested $80,000 for Superman, $112,000 for Batman, and $128,000 for Aquaman for the partnership, the Justice League. During its first calendar year, the partnership earned $249,000. The partners had withdrawals of $10,000, $5,000, and $20,000. Prepare the year-end entries to allocate the $249,000 net income to the partners under the following assumptions. In Assumption A, the partners have no agreement on the method of sharing income and loss. When there is no agreement in place, it's just split equally between the partners. Since there are 3 partners, it'll be a third to each one of them. A few slides ago, I showed the journal entry. We start with income summary, and then we list all the different partners. We have 3 partners here. We'll list their capital accounts: Superman Capital, Batman Capital, and Aquaman Capital. The amount for income summary is the total amount of net income, which is $249,000. Now we need to split this up between those 3 partners. Since it's equally, we'll do $249,000 divided by the 3 partners, which would be $83,000 each. Superman's capital will increase by $83,000, Batman's and Aquaman's as well. Then if they want, they can withdraw these funds out. Let's look at part B now. It's the same situation. In this case, the partners have agreed to share income and loss in the ratio of their beginning capital investments. Let's put in the journal entries. It's still income summary, along with the 3 partners, Superman, Batman, and Aquaman. The total amount of income is still $249,000 to be split up. We're just going to split this amount up differently than we did in part A. In this case, we have to look at the beginning capital investments. We'll look at the total investment and then each partner's individual investment and divide to get a percentage for each. Then we will take that percentage and multiply that by the amount of income summary, which is the amount of net income. The partner with the most capital contributed will get the most income. The partner with the least will get the least. Here is all of the capital I got from the beginning. Superman had $80,000, Batman $112,000, and Aquaman had $128,000 invested in the company. When you add this up, this is a total of $320,000. We want to take each of the investments and divide it by that total. For example, Superman's $80,000 investment divided by this total of $320,000. Then we'll do Batman's $112,000 divided by that $320,000, and then Aquaman's $128,000 divided by that $320,000. Each one will give us a different percent. Superman's would be 25%, Batman's is 35%, and Aquaman's is 40%. We're going to take these different percents and multiply it by the total income of $249,000. 25% of $249,000 is $62,250. That's how much Superman would be getting. Batman's percentage would be 35% of that income, which would be $87,150. Aquaman's would be 40%, which would be $99,600. You should also add up all the credits to make sure it equals the debits. This is a good way to check to make sure that you have the right amounts in there. Next, we have part C, which is a little bit more complicated. We have a little table to help out with this. The partners agreed to share income and loss by providing annual salary allowances of $66,000 to Superman, $56,000 to Batman, and $80,000 to Aquaman. They are also granting 10% interest on the partner's beginning capital investments and sharing the remainder equally. This table is used to help us before we do the journal entries to figure out how we divide this income. The first line, let's put the total balance of the net income in, which is the $249,000. The next line is salary allowances. We'll give the salary to each Superman, Batman, and Aquaman as listed above. Superman's would be $66,000, Batman's would be $56,000, and Aquaman's would be $80,000. So the total's right there. We're going to add them up to get the total of salary to all three. When you add these up, you get $202,000. We have $249,000 to split up. So far, we've given out $202,000. What's the balance? That would be how much is left after we gave out the salary allowance. $249,000 minus $202,000 would be $47,000. That means we have $47,000 left to give out. The next line is the interest allowance. Interest is 10% of the beginning capital balances. This is listed in the beginning of the problem. I also put it here to reference it. These are the beginning capital balances. We want to do 10% of each of these and give it to those three partners. 10% of $80,000 would be $8,000. 10% of $112,000 would be $11,200, and 10% of $128,000 would be $12,800. Once again, we want to total these up to get the total, which is $32,000. We had a $47,000 balance, and now we just split up $32,000 more. Our balance after this would be $47,000 minus $32,000, which leaves us with $15,000. It says that the rest of it is shared equally, meaning this remainder of $15,000 needs to be shared equally between the three partners. How would we split up $15,000 three ways? It would be $5,000 each. 15,000 divided by 3, 5,000 to Superman, 5,000 to Batman, and 5,000 to Aquaman. A total of 15,000. The balance is now 0, and that's what you want for it to be 0. What we're doing is taking the full amount of income and dividing it amongst the different partners for the full amount. We're not going to do less than the income or more than the income. We're going to do the exact amount of it. The last part is just totaling it to see what the total is going to be for the three different partners. We're going to add up everything for Superman. 66,000 plus 8,000 plus 5,000 would be 79,000. Then we would do the same thing for Batman. It would be 72,200. And finally, for Aquaman, it would be 97,800. This chart really just helps us figure out how we're splitting it up amongst the three partners. The total is 249, which is what we want to give out. We always want to give out the full balance. The final balance is now 0 because we did give it all out. The journal entry is done the same way as in part A and B. We'll first list income summary and then the three capital accounts. We'll put the full amount of income into the debit spot. And now we'll put what we just did for part C here, the totals for Superman, Batman, and Aquaman, into the credits here. Superman, Batman, and Aquaman. The journal entry was done the same way for parts A, B, and C, but how we split up the money, that's what was done a little differently. Once you're done allocating the income to the partners for the year, you want to create a capital statement, which is basically a summary of how the capital account changed from the beginning of the year to the end of the year. You would increase the capital account when the partners invest money into the company or other assets. And then when the company earns net income, that will increase the partner's capital accounts. What will decrease the accounts are when the partners withdraw from the company or if there's a net loss. Obviously, there's only going to be either a net income or a net loss, not both. This is what it looks like. I made one sample for one partner. You start with the beginning capital of the beginning of the year. Any of your additions you put in here. If there is a net income, you add that partner's share, along with any new investments the partner made, if they did make any. You're not going to be using all these lines. Total it up, and then do your subtractions. If the partner withdrew money from the partnership, that would go here. And then if there was a net loss, that would also be subtracted from it. Like I said, you're not going to have all of these lines. Like you would not have a net income and a net loss at the same time. You would have one or the other. Once you total everything up, that would be their capital at the end of the year.